For this course, you will have 8 insurance accounting problems. These accounting problems will help to illustrate many of the concepts we've discussed throughout the course. I will walk you through the first insurance accounting problem, so you'll know exactly how to do it. For most problems, I will add an element of complexity. I will create another video to show you how to do some of the more complex problems. So there won't be anything in the problems that I won't have shown you how to do. This template that you see on the Excel spreadsheet here is exactly what every problem will look like. The only thing that will be added will be the variables you see here. These numbers will be the only thing that will change with each problem until number 8. And I will add some additional variables with several of the problems. You have 2 options in terms of how to turn these in. You can either do the problems in the Excel spreadsheet and resave them, or you can print these problems out and scan them in and upload them as PDFs. However, you do need to show all of your work, whether you do it as a formula in Excel or you write it in. The way that I'm going to do it is to show it by hand on this Excel spreadsheet. But again, it's all right if you create formulas and save it as an Excel document. What these insurance accounting problems do is they show how the operations of an insurance company actually affect a simplified balance sheet. As we discussed in the accounting and financial statements video, these are the major accounts that an insurance company has. So this is the balance sheet at the very beginning of this insurance company's operations. They will have cash of $1 million, stocks of $500,000, and bonds of $100,000. Then they will have unearned premium reserves of 0 because they haven't written any premium yet. Similarly, they will have loss reserves of 0, and all of their liabilities and surplus will be in policyholder surplus of $1.6 million. That's just at the beginning. So over the first year, they write $1.7 million in this particular problem. And all of this in this problem is written on 7/1x1. For this problem, they will pay out all of their losses in the first year, 100%. And in this case, we will ignore any investment earnings, but we will add that in subsequent problems. We also have a loss ratio of 65%, which we will always have some percentage here, and an expense ratio of 30%. So let's go ahead and fill in our premiums written and earned for years 1 and 2. Since we have a premium written of $1.7 million, and it's written all on 7/1x1 or July 1st, we're going to write $1,700,000. In a later problem, you can have premium written in X1 and X2. But in this case, premium written for X2 is 0 because all of our premium is written in the first year. But when premium is written on 7/1x1 and we assume 1-year policies, half of that premium will actually be earned in the second year. To show what happens, let's look at a 2-year timeline. Let's assume this is X1 and this is X2, with this being December 31st, X1. And all of this premium is written on 7/1x1. And since we have 1-year policies, we know that all of it will expire on 6/30x2. So half of the premium will earn in X1 and the other half will earn in X2. Half of $1.7 million is $850,000. So $850,000 will be earned on all of these policies in each year. So our premium earned for X1 is $850,000 and our premium earned for X2 is also $850,000. I don't need you to show these timelines when you calculate this unless it helps, but any work that you do, you should write down or show a formula. Now we need to calculate losses and expenses, and it will be fairly easy in this first year. We'll start with expenses. The expense ratio is 30, and remember that expenses are as a percentage of premium written. So if we multiply our 30% times our 1.7 million, that gives us $510,000 in expenses for year 1. Now for losses, we have a 65% loss ratio. So 65%. And remember, losses are taken against premium earned. So that's $850,000. So my losses are 65% times $850K for $552,500. Again, this is for year 1. Now, we can go ahead and calculate year 2 in this case, but you'll need a total from year 2 when we get the investment income rate. But for this time, let's go ahead and calculate year 2 expenses and losses. Our year 2 expenses are our 30% times our written premium of year 2, and that's here, and that's 0 in this case. So our expenses for year 2 are 0. Our year 2 losses are 65%, and the number happens to be the same because we earned half of it in the year 1 and half of it in year 2. So 65% of $850,000 for, again, $552,500. So now we need to put these numbers into the T account where appropriate. I'm going to adjust the width of these for purposes of illustration. So let's begin with premium. In some cases, you will have these labeled, but be careful because you won't always use all of the labels. For example, in this problem, we don't have interest earned because we have a 0 investment income rate. So let's first discuss what these T accounts are. First, you have cash, and you will always have the same 4 T accounts in every single problem. You will only have to deal with these 4 T accounts. They are cash, loss reserves, unearned premium reserves, and income, where the income statement affects policyholder surplus. Cash is the only asset account. We're going to assume that stocks and bonds stay the same every year for purposes of illustration, and we're only going to deal on the liability side with loss reserves and unearned premium reserves, and of course the policyholder surplus. So what happens when an insurance company writes $1.7 million in premium? It will increase your cash account by $1.7 million. That is a debit to cash. But remember from accounting that we always need an offsetting credit for every debit or set of credits. So remember, we don't get to recognize all of our premiums earned over the year unless they've actually been earned. And what the T accounts show is what happens over the year. In year 1, we earned $850,000. So we get to show here in income $850K in earned premium. The remainder has to go into an unearned premium reserve. So that's why I show here written premium minus earned premium. And again, that is a credit. Remember, on the liabilities and owner's equity or policyholder surplus side, an increase in an account is a credit. So 850 here and 850 here in income offset our 1.7 million. Always make sure that you have equal credits for your debits. The next thing to look at is expenses. This insurance company pays out $510,000 in expenses. So we know that we reduce cash by $510,000. A reduction in cash on the asset side is a credit to cash. So we put $510 in expenses, and the offsetting entry is in income for $510,000, a reduction in income. Similarly, for losses incurred, we have $552,500 in year 1. So $552,500. We pay all of that in this first year because we had 100% loss payout. So losses paid, which comes out of cash or a credit to cash, of $552,500. And we're done with our year 1 account entries. All we have to do now is get our balances. The net is $637,500 on the debit or positive side on the asset side. And of course over here, $850,000, an increase in our unearned premium reserve, and our net in income is a debit, a reduction of $212,500. So right away you can see how an insurance company that's growing actually looks like they're losing money because this $212,500 is a negative. This company is actually growing by writing premium, but temporarily it will look like it's losing money. The loss reserve is not touched in this problem because of this 100% loss payout, but in subsequent problems you will have a loss reserve. Now let's bring these numbers back to our balance sheet. So again, what happened in these accounts is what happened over the year. Now we want to look at a snapshot of a point in time, the first day of the new year, 1/1x2. So we need to know where our accounts are on that day. You don't have to illustrate what I'm about to do necessarily, but I want to show you this for purposes of illustration. The 637 is an increase in cash, so we add this to our cash account from last year, 637,500. So our cash account is now 1,637,500. Our stock account is 500, and this will always be the same, and our bonds will be 100,000. On the unearned premium reserve side, we add 850 because we had an increase in that account of 850,000, and we had no activity in the loss reserve, so that will remain at 0. But in our income account, we had a negative 212,000. So let me do it here. 1 million minus 212,500. Let's not forget our 500. And that gives us 1,387,500. Our totals should now be the same. 2,237,500 on the asset side and 2,237,500 on the liability side. If they're different, you need to go back and check where you made the mistake, because every credit or credit should have an equal and offsetting debit or debits. Now let's go to year 2. But I first want to write down our balances. So remember, we had written premium of 0. We're ignoring interest earned. Our expenses, which are based on written premium, are 0. So we put 0 here. In this case, we ignore last year's losses paid because we paid out 100%. So we're only concerned about this year's losses paid, which is again 552,500. And we have an offsetting debit of 552,500. As you do this over and over again, you'll get used to it. I'm going to erase this. Now we did earn some premium from last year. Our last year's unearned premium reserve was 850,000. So that 850,000 must be earned this year. It is in fact earned in year 2. And that same 850,000 will show up in income. So it is a credit to income. And again, we ignore interest earned. We also don't have a loss reserve because we do a 100% loss payout. So let's do our totals. For cash, 552,500. For income, a positive 297,500. And for our unearned premium reserve, a negative 850,000. Now we have our balances over here. So our cash account is now 1,637,500 minus 552,005 because a credit on the asset side is negative. So that gives us a balance of 1,085,000. Again, that is our balance from last year of 1,637,500 minus our 552,500. Stocks and bonds stay the same. I'm just going to put a 600,000 here. Our unearned premium reserve was $850,000 last year. I'll just write that up here. And we minus 850,000. I want you to always think about the logic of this, because we've now earned all of the premium. That unearned premium reserve should be 0. So it does make sense. At this point, it's fairly simple to see that. But as our problems get more complicated, it will help a lot to think about the logic of what's happening. Our loss reserves again are 0 because nothing happened there. And our policyholder surplus, which over here was 1,387,500, is now increased by 297,500 for a total of $1,685,000. So in the end, this company made $85,000, which is the difference between $1.685 million and $1.6 million. Our totals here are 1,685,000 and 1,685,000 again. And that's all you have to do for problem 1.